All right, we're going to go ahead and get started. Welcome to Essential Investment Concepts. I am your host and presenter. My name is Corey Nepper. I am an investment advisor representative, meaning I'm a licensed fiduciary financial advisor. I've been in the finance industry for about 7 years and have a bachelor's in financial services from Maryville University here in St. Louis. We're located in Westport Plaza off of page in 270, and the intention of this presentation is to provide a basic level of investment knowledge. We're not going to be deep diving into any one specific topic, sector, or speculation on any stock market or security. If you would like to discuss markets and securities with me, I'd be happy to set up a call and we can do that. So let's get into essential investment concepts. The first one we're going to start off with is dollar cost averaging. Now, this might not seem like as much of an investment concept as it is a budgeting concept, but they work hand in hand, with the goal being we're going to be able to put more money in to our investments, therefore seeing them grow. And the way that we do that is through a process called dollar cost averaging. You might already be doing dollar cost averaging if you're participating in your company's 401k. By investing money in regular intervals, you help reduce the impact of market volatility. Dollar cost averaging is shown to reduce emotional investing and encourage disciplined saving. The saying in the industry goes, it's time in the market, not timing the market. Timing the market is hard. It's pretty much a lot of people believe it's gambling, as opposed to investing. And attempting to do so, you can leave a lot of money on the table. And by dollar cost averaging, we buy more when prices are lower, and we're going to buy fewer when prices are higher. This should lower our average cost per share in the long run. So a quick example that I can give, we're putting $100 in, we're buying a fund that is $10 a share. We're going to buy 10 shares, right? Well, the next month, whatever reason, it drops to $5. Well, now we're going to buy 20 shares. And then the next month, it's $10. So we're going to buy another 10. So now we own, 40 shares with an average cost basis of $7.50 a share. So this is kind of the way that we can lower our average cost per share in the long term. Now that we've talked about how to put money into the portfolio, let's talk about the investments inside of them. We're going to use the risk mitigation technique of diversification. Basically, don't put all your eggs in one basket, right? We spread our investments out through multiple asset classes, sectors, and geographies. The reason we do this is to try to eliminate or minimize the impacts of what is called unsystematic risk. Unsystematic risk is a risk that only certain sectors and investments face. For example, a social media company whose primary source of revenue is through ad sales could be subject to political risk, because if a law is passed that hampers their ability to collect data, now we're going to see their top line get hit because advertisers won't be able to target their consumers as well as they did before. Take a look at, maybe look at an oil company. They're not going to have that problem, right? They're not going to have a problem with data manipulation and stuff like that. However, they could have problems if there's an oil spill or if oil prices skyrocket or plummet, whereas the social media company doesn't really have those risks. Oil prices don't affect a social media's company's stock price very often. Systematic risk, however, is something that everybody has to deal with, right? Best examples recently, COVID in 2020, inflation in 2022, world wars, things like that. Now, certain companies and sectors might be better positioned to handle certain systematic risks. For example, technology companies that were nicknamed the stay-at-home stocks. The stay-at-home stocks did really, really well in 2020. However, going back to the oil thing, energy stocks, not as much. So these are kind of different ways that we can mitigate our risk. So we can mitigate it through diversifying through asset classes. Asset classes are different types of assets, meaning stocks, bonds, real estate, and then alternatives is not just Alternatives is a very broad piece. So a stock is going to be owning a piece of a company, even if it is a very small piece. Bonds are going to be loaning money to a company or a government entity. Real estate, whether you own rentals, an Airbnb, or it can be securitized through a real estate investment trust, or REIT for short. Then we have alternatives. A couple of examples would be commodities like gold, um, hedge funds, private equity funds, things like that. You can also diversify within asset classes. So I might only purchase only purchase stocks, but I can purchase large cap stocks, mid cap stocks, small cap stocks. A small cap stock is not your mom and pop shop that makes, a couple $100, maybe a couple $1,000. A small cap stock is between 800 million and 2 billion in market capitalization, meaning if you wanted to purchase that company outright, you would have to pay somewhere in that amount for 100% of their stock. Large cap is going to be anything over 20 billion, and mid cap is going to be anything in between. There are thoughts and ways to also look at stuff like mega cap, which is, in today's day and age, $20 billion companies, there's a lot of them. There's trillion-dollar companies, multiple trillion-dollar companies now. So mega caps are going to be those massive, massive companies that are that size. And then there's also micro caps, which are going to be smaller than small caps. Not exactly something that I would recommend. If you've seen the movie Wolf of Wall Street, you know what a microcap company can entail. And finally, we can diversify across sectors and across geographies. Sectors meaning technology, healthcare, energy, consumer services, stuff like that. So there's a bunch of different sectors, and geographically, there's domestic, there's international, and there's also considered emerging markets. So an emerging market is kind of a developing nation. International might be a little bit more developed nation. Now, if we look at something like the S&P 500, pull up my little laser pointer here. The S&P 500 is the best indicator of or most accepted indicator of the U.S. economy because it is the top 500 large cap stocks in the United States, and the primary sector is technology. Now, you look at something like the Russell 2000, which is another sector, which some might argue is actually a better representation, and that is 2,000 small cap stocks across multiple sectors in the United States. And if you look at something like a typical 60-40 target fund, that might be 60% domestic, 60% international, diversified across a lot of different asset classes, across a lot of different sectors, and it might be 60% stocks and 40% bonds. Having a portfolio that hits the components that you are looking for within your risk tolerance and your time horizon is the biggest key to investment portfolio management. And while your risk tolerance may be low, time is your best risk mitigator. If you have a long period of time, you can invest more aggressively. If you have a shorter period of time, we would rather protect what we have built. Now we're going to move to not just what goes into the portfolio, but the actual different account types. This area, in my opinion, is probably the more misunderstood area of investing, and probably the most important area. Maximizing our tax benefits on our investments is something that can be done at every level. So let's start with qualified versus non-qualified, and then we'll dive into what qualifieds are, and then we'll dive into non-qualifieds and the differences between the types of accounts there. So qualified account, as you can probably guess, is something that's going to have tax benefits. These tax benefits come with a caveat, though. They usually will have things like contribution limits, income limits, and withdrawal rules. A non-qualified account will not have the tax benefits that a qualified account does, but it will have the benefit of being more liquid. Examples of a qualified account include a 401k, a 403b, a TSP, or an IRA, among many others. And then a primary non-qualified account is going to be nicknamed the brokerage account. These can be owned by individuals, multiple individuals, entities like a business or a trust. So we're going to start on the qualified side, and we're going to talk about, I'm going to get through this piece here. This is usually the time that, as a financial advisor, I spend the most of my time planning with a client, is basically figuring out if they would be better served by a Roth heavy strategy or a traditional heavy strategy. The difference between the two is tax treatment. So biggest reason is the biggest difference between the two is tax treatment. The tax treatment of a traditional is basically you're not going to pay taxes on it now. So let's say I make $100,000 and I put $5,000 to my 401k, my traditional 401k. I'm going to only pay taxes on $95,000 because I've deferred the taxes on that $5,000. Now, whenever I do take that money out, I'm going to pay taxes not just on the amount I'm taking out, but also on the growth. Whereas the Roth, let's say I contribute to the Roth 401k portion, and I contribute that $5,000, I'm still going to pay taxes on $100,000. However, when I take that money out, the goal will be to take it out tax-free. Now, there are certain different ways to say that we have tax-free withdrawals or qualified withdrawals for Roth IRAs. The biggest one is being over 59 and a half. The age 59 and a half rule hits both the Roth and the traditional, and I'll go into a little bit more detail on how that works on the next slide. The next slide is also a graphic that will give you kind of this in a more visual sense. The other piece with traditional that Roth doesn't have is traditional has required minimum distributions, or RMDs. Currently, RMDs are set to start at age 73, but changes to that will make it 75 in 2033. Now, RMDs can really eat into your estate planning and stuff like that, but over the idea of RMDs is it's Uncle Sam saying, you haven't paid your taxes, it's time to pay your taxes. So you need to take out 3.25% of your traditional portfolio. And if you don't take it out, we're going to tax you 50% of what that number is. And then it continues to go higher and higher and higher as you get older and older and older. You can't avoid these RMDs by doing a Roth conversion before that age, but that's a different topic for a different webinar. Like I said, here's the infographic. Roth, we're doing it post-tax. We take it out tax-free. It is set to an age 59 and a half penalty. There are income limits on Roth IRAs. There are no income limits on Roth 401ks or TSPs. There are contribution limits for both, and there are no RMDs for participant Roth IRAs. There are RMDs for participant traditional IRAs. Like I said, this one's going to be pre-tax, and withdrawals will pay income tax. So a quick example of pulling money out before age 59 and a half and how the treatment is different. If let's say we put $70,000 into an account, we're going to put $70,000 into a Roth, we're going to put $70,000 into a traditional. They both grow $30,000 to $100,000. We take this money out because we need it for whatever reason. The traditional, you're going to pay 10% penalty, so $10,000, and then you're also going to pay the income tax on it as well. Let's say the income tax is 25%. You're going to be paying $35,000 to take out the original $70,000 that you put in. The big reason for that is you still never paid the taxes on it. Whereas the Roth, you've already paid the taxes on it, so that $70,000 of contributions aren't applied to the 10% penalty or the income tax that the growth has to deal with. So you would pay income tax on that 30%, and you would pay the 10% penalty on that 30% as well. So you'd pay $10,500, $7,500 for the tax, $3,000 for the penalty. Now we're going to jump to the non-qualified or brokerage accounts and different ways to use those. The brokerage account is an incredibly versatile tool. There's no RMDs, there's no age-based penalties. You can take money out, you can move money in whenever you feel necessary. You can make trades in these accounts, you can trade whatever you can utilize a lot of different securities in this. Personally, the way that I like to use it, especially for younger families and people like that, is I like to use it as a income generation tool. The way we do that is, let's say we have a couple making $150,000 a year, and they decide to put $75,000 in emergency savings because that's 6 months of salary. We can then use that emergency savings to generate more income. So if we can keep $15,000 in that savings account for what we would call pop-up emergencies, car needs tires, water heater broke, need a new roof, have to pay the deductible, things like that. Then we can invest the remaining $60,000 into a fund with a low standard deviation that is hopefully there's going to be a lower risk fund, but it's going to have a high dividend yield. We then take that dividend yield and we can then put it towards something else, like a 529 plan. Or maybe a Roth IRA. So we're going to start wrapping up here with a couple of different other account types. The health savings account, or HSA, is probably the best account when it comes to tax qualification. As you put the money in, it is tax deferred, meaning that we are not going to pay taxes on it this year, or we're only going to pay it if we take it out and put it into our account. However, if it's used for qualified medical expenses, it is going to be tax-free. Most HSA plans will give you basically a card to pay with, and you can pay your medical expenses with that. Then we have 529 college savings plans. These are going to be used similar to a Roth, where you're going to put the money in after tax, and it can be used for qualified education expenses, tax-free. This allows us to grow the account tax-free and then use it for paying tuition, room and board, books, things like that. It can also, the idea of qualified education expenses has changed a lot in the last 10 years or so. Before, it was only used for certain, institutions and universities. Now there are certain trade schools that it works for. You can also use it for K through 12 private school tuition. And if the funds go unused, you can change the beneficiary, or if it meets the prerequisites, you can roll it into a Roth IRA and not pay any taxes on it. Finally, we have custodial accounts. These are non-qualified accounts that are meant for adults to save money for a minor until they reach adulthood. These do not have to be used for educational purposes, and the two main ones that are used are called UGMA or UTMA, named Uniform Gift to Minors Act or Uniform Transfer to Minors Act. They're very similar. They do have some slight differences, but we are not going to get into those today because we are going to wrap up here. Biggest things when going forward is understand your investment plan. You don't need to have an account for every nickel and dime, but you should have an idea of what certain breakpoints are for you in your future. Far too often we see people that think they're doing the right thing only to find out that they left hundreds of thousands of dollars on the table whenever they get to the point of it's time to retire. Next, we want you to make sure that you understand what is best for you. Understand that you should have a budget that works properly for you when it comes to dollar cost averaging. Understanding how to diversify so that you're not going to be overexposed to one market. Understanding wit and your risk tolerance so you can know what you should be looking at when it comes to bringing money in down the line. The only thing, so only you know your preferences and what is important to you. The important thing is understanding your budget, risk tolerance before investing. If you are curious about working with an advisor, you can set up a time with me and we can discuss your financial situation and see if there's somewhere we can make some improvements. Thank you for attending today. Here's our